Hello, Metastock traders, and welcome to video number 4 in this 6-part educational web series from GoNoGo Charts. My name is still Tyler Wood. I am still a CMT charter holder. And with me, as always, is Alex Cole, the chief of charts here at GoNoGo. How you doing, my friend?
Fine. Getting through it. I'm still here.
Every day we arrive above ground is a new opportunity. So, building upon the first 3 lessons, let's dive into what we're talking about today, and that's the interplay between the GoNoGo trend indicator and the GoNoGo oscillator. Now, a quick review, we've been talking about having a rules-based approach, a checklist, if you will, giving us the weight of the evidence, but we don't want this. We don't want analysis paralysis. We don't want to clutter our charts with endless indicators. We just want to preserve the information that they are providing us so that we can see clear signals and take quick actions with our account. Now, Alex, talk to us about the complete solution from GoNoGo Charts here on Metastock.
Yeah, so we're going to work through this complete solution through the 6 videos, and today we're going to talk about the third piece, which are our GoNoGo icons. We've already talked about the GoNoGo trend. It blends objective foundational concepts of trend following into an indicator that colors the price action based on trend strength. That keeps price the focus. We've already talked about the GoNoGo Oscillator does the same thing for momentum analysis, allows us to see divergence, allows us to see areas of overbought and oversold levels. Today, we're going to talk about the interaction of the GoNoGo trend with the momentum oscillator and how we highlight important scenarios by using the icons that Tyler's highlighting right now. So those are the GoNoGo icons, and we'll get into that as we go through this video.
And in our next video, we're going to cover the GoNoGo squeeze and volatility compression. So a lot to look forward to, but let's dive right in. Alex, what are we looking to do?
So when we are looking at charts as technicians, we've said this before, we are trying to participate in trends, not anticipate. So we're not trying to predict, we're trying to react responsibly. And if we can do that, we remove doubt, confusion, uncertainty, and it allows us to stick to our rules, to follow our process, and remain objective. And then in that way, hopefully, we're acting responsibly and without the normal pitfalls that are associated with emotional trading.
Now, we can get mathematical and talk about our trading systems. We can look at any of our individual trading accounts and understand that behavior is working against us. As human beings, we have in our nature these intrinsic biases that actually work in opposite fashion to what we want in the markets. Now, our profitability is simply the combination between the percentage of winning trades and the profit ratio of those trades. Do we let our winners run? Do we cut our losers short? David Ricardo told us these very self-evident lessons in the 16th century, and they still hold true today. But behavioral economists like Daniel Kahneman and Amos Tversky developed the prospect theory, where they identified in human beings the fact that we experience much more pain in suffering a loss than we experience joy in capturing a gain. And that works against us. That means we're holding our losers and we're cutting our winners short. We want to lock in those gains after the first 5 or 10% of a move, and we tend to hold our losing trades in the hopes that they will come back to a break-even position so we don't have to recognize that loss or admit that we were wrong. Let me tell you here today, folks, that in trading, we are going to be wrong, and it's okay as long as we limit the size of those losses. So this expectancy formula, this quick graphic here on the right side of the chart, can tell us where we will find profitable trading systems. And it's that combination, again, between percentage of winning trades and the profit ratio therein. Let's just pick on this dot for 1 second. This is a 50-50, right? If we just flipped a coin to decide whether or not to buy or sell a security, that might be our entire analytical discipline. No idea what the ticker symbol is, no information about the company, no technical analysis, just flip a coin. Do we buy Apple or not? Well, we could still break even on that kind of a trading strategy so long as when we flipped the coin, bought the security and it was trending higher, we stuck with that. And when we flipped the coin and it traded lower, we got out. in a 2-to-1 ratio, right? If our profits were 2-to-1, we would be able to break even. Now, some of the best trend following investors in the world live somewhere up here where they are wrong a lot more than half the time, and they're comfortable with that so long as they can lean into the securities that are working. You get those outsized gains that erase all of those very small losses. When you think about Jerry Parker at Chesapeake Capital or David Harding at Winton Capital, they're widely diversified trend followers. They're placing lots and lots of trades, small positions, and then they can lean into and accelerate the gains as they scale up their position. They are really phenomenal at what they do. And just think about Major League Baseball for a second. If somebody bats 300 throughout their career, little kids are trading their card and they end up in the Hall of Fame. Well, a batting average of 300 means that every time they step up to the plate, they're striking out 70% of the time, right? But we're going for those home runs. And so when we look at this expectancy formula, we can see that as long as we are managing our trade risk management, our trading process, it's not all about getting the directional bet correct. And in other presentations, I'm sure you've seen Alex and I talk a little more about some of the survey data and some of the great behavioral economists who have tracked many traders and how these behaviors can get in the way of profitable trading. So with GoNoGo Charts, we want to improve our edge, our strategy through analysis. We want to identify those securities that have the highest probability of trending in our favor. We also want to use these tools to develop a more robust trading discipline. So Alex, quick review. We talked about momentum concepts. Remind us once again what we're trying to do with these leading indicators.
Yeah, again, just because they give us so much valuable information, we want to include it into our complete chart. We want to get an idea of where the prices move too fast in any one direction. We want to get a sense of divergence, and we can do that all with these oscillators, but we can also complicate our chart by adding them one after the other below our chart. But this is some of the bit that we really want to talk about now, is the fact that we can use the oscillators in trend. And that's where the GoNoGo Oscillator really comes into its own. Like you said, Tyler, it's about managing those positions. And if you stay with the ones that are winning, that's what it's all about. So let's talk a little bit about the GoNoGo Oscillator and the zero line. We know that we can use oscillators to help us when in trend. A lot of research was done, people like Connie Brown and others, to understand how to use what the momentum indicators are telling us when a security is trending, not when it's moving sideways, as perhaps we think they were designed for. So what you end up doing is looking at something like an RSI, something like a stochastics, and noticing that it tends to move in a range. It'll go from overbought to neutral, overbought to neutral. But we hinted at it in the last video that it becomes subjective there, because what is neutral? What is overbought? Is moving to a value of 69 enough for RSI, or what about 71? You know, how overbought does it need to be, or how solid does the support level need to be that you're identifying on an RSI? If you try to identify a level of support around 40, what if it hits 42? Does that count as tagging support? What if it breaks 40 but holds at 38? Has that broken support? So we can do some really good work using momentum indicators in a trend, but it becomes difficult to be objective and to really understand what the indicators are telling us. So what we've done with the GoNoGo Oscillator is calculate it in a way that causes the indicator to fall or rise to the zero level when all of the inputs to that blended momentum calculation, all of them are in their respective neutral territories. So think about something like RSI, again, between 30 and 70, stochastics between 20 and 80. And, you know, it goes on and on. When all of those are in neutral territory, GoNoGo Oscillator hits zero. So if you think about that, when the oscillator is, when the trend, is a go, and the oscillator falls to zero, we're seeing waning enthusiasm. Now, that is totally normal in a trend. Price will not move in a straight line. It will move up, it will come back. It will move up, it will come back. But every time that momentum wanes and price comes back, we can now look to the zero line on the oscillator to see if it holds. And if it does, we can say that we aren't seeing any oversold readings. They've gone to neutral, but they've stayed at neutral. And then when they rally again, we come off the zero line, and that tells us that the trend is likely to continue. Gives us an objective level of support and resistance and allows you to stay with the trend.
Now, right after my MBA program, following the great financial crisis, I met a gentleman named Ralph Acampora, who's been a wonderful friend and mentor, and he explained momentum to me in this metaphor. He said, "Tyler, picture a baseball in your glove." Ralph's from the Bronx; he's Italian. Everything's baseball with these guys. He said, "There's a baseball in your glove, and when you throw that ball in the air, momentum is going to move fastest the moment that it leaves your glove. That's the fastest that ball will be moving. And then as it reaches the apex, the highest point at which you've thrown it, it's still moving higher, but it's moving higher more slowly. And then what happens to that baseball? Well, it comes back down to earth. Gravity brings it back down. And as long as you catch it in your glove, the game of catch can continue. So I'm going to extend Ralph's metaphor here for just a second. When we are in a trending security, and as Alex was saying, momentum will surge and then cool off, and surge and cool off. And every time the GoNoGo oscillator comes back to that neutral level, we have an objective zero line offering us support in a trending security. And where it finds support, that's where momentum is going to surge again in the underlying direction of the trend. I'll say that one more time. When momentum is surging in the direction of the underlying trend, that is the sweet spot for trend following investors. Remember the expectancy formula from just a minute ago. If we want to lean into our winning positions, we have to know where those buyable dips are. We don't want to trade irrationally and say, BTFD, as many of the meme stock traders taught us in 2020 and 21. Instead, we want to have a quantitative level of evidence that tells us when there is a opportunity to buy into those dips, when trend is going to continue in its underlying direction. So here, as we see this chart, we've got icons in the price panel that are going to highlight these interactions with the GoNoGo oscillator. Alex, why don't you talk to us a little bit about these GoNoGo icons?
So having said all that, and having now understood hopefully the value of the zero line with the oscillator, we've also built into the chart some icons because there is such power in data visualization. So we know we've gone through the process of trend identification. We've gone through the process of understanding momentum. We know the importance of the zero line and how the trend interacting with the oscillator is so important. But let's now draw our eye back to the price chart, right? We're very, very keen to use the tools at our disposal and the power of data visualization to keep us focused on the chart itself. So the first icon that we put on the chart are called trend continuation icons. And those are the situations, just like Tyler was talking about, where he's throwing the ball, he didn't drop the ball. Good job, Tyler. And the game of catch is able to continue. The trend is likely to continue because we're highlighting the return of momentum in the direction of the trend. So those are the circles, trend continuation icons. The other type of icon that we have on the chart are counter trend corrections. And those are because we also still want to see those moments where we might be looking at momentum in its more traditional sense, understanding where we see the end of overbought or oversold extremes. Remember, when prices swung really quickly in one direction, maybe it will come back for a time. So those red arrows are counter trend correction arrows, telling us that in the short term, we may correct against the go trend. It may struggle to go high. Now, these are not a reversal signal. These are not saying, hey, we're going to enter a no-go trend. Remember, this is a counter trend correction within a go trend. And then what would we do? We would look to the zero line and see if we get a green circle that follows then that counter trend correction icon. But depending on who you are and depending on what you're trying to do, those could, of course, be appropriate times to maybe lessen positions or to get out of a situation there.
And a lot of our portfolio management clients over the years have found that they trim or they add to positions based on those momentum readings. So they want to hold a position through the life of the trend, but they find these opportunities to perhaps trim a little bit of their position size and then add to it at these logical points of reentry where you see momentum leaping off the zero line and resurging in the direction of the trend. That's how they're able to stick with something through the life of its move and to get those outsized gains. Now, the last piece that we want to mention is that GoNoGo charts are not designed just for long-only investors. Many of you may trade to the short side, trade futures or other options instruments, and you can use the same concept in reverse. So here we have a no-go trend. The trend conditions are in pink and purple bars. We can see that it's moving in a series of lower highs and lower lows. When we're looking at a chart like this, we see the momentum oscillator move to extreme levels of oversold and then come back to test the zero line. So the icons are going to work the same way, but in reverse, where we have trend continuation icons. We see the circles. They are red in no-go trends, green in go trends. But the circle icons tell us that momentum is resurgent in the direction of the underlying trend. So we have enthusiastic negative momentum coupled with this downward no-go trend. And then same is true in the reverse. When we see extreme oversold readings, we want to mark those counter trend correction arrows that in the short term, price may struggle to move lower. It's not an absolute trend reversal or a sell signal to get out of that short, but perhaps covering some of that position would be a responsible move. So hopefully this lesson in understanding the interplay between momentum and trend will help you in thinking about your own trading strategy and your own discipline. And that's really one of the things that we find most beautiful about putting this algorithm and this multi-factor model back into a chart is that it's in your hands and you can decide how and when and over what time frame you want to trade those charts. Thanks so much for being with us here on video number 4. If you have any questions for Alex and I, please feel free to shoot us an email, info@GoNoGoCharts.com. Until next time, trade them well.